This is the third presentation for Chapter 21, Accounting for Leases. This part will cover the first two appendices for Chapter 21. The first learning objective will cover lessee accounting for sale-leaseback transactions, and the second one will cover direct financing leases for lessors. In this learning objective, we will cover lessee accounting for sale-leaseback transactions. Sale-leaseback transactions occur when a company that presently owns an asset sells the asset to a financial institution and immediately leases the asset back. If control of the asset has passed from the seller to the buyer, then a true sale has occurred. We will see that transfer of control occurs when the leaseback is an operating rather than a financing lease. If the lease meets one of the criteria for a finance lease, then control is not considered to have passed and the transaction is recorded as a financing transaction rather than a sale. This is often referred to as a failed sale. For the illustration of a sale-leaseback that will be considered to be a true sale, we will first assume that Scott Paper Company sells one of its buildings having a carrying value of $580,000 to General Electric for $623,110. It then leases the building back from General Electric for $50,000 a year for 8 years of the building's 15 years of remaining economic life. The present value of the lease payments is $310,000, so that this lease would be classified as an operating lease because none of the criteria for a finance lease were met, including lease term and present value. To record the sale of the building to General Electric, Scott Paper would debit cash for $623,110 and accumulated depreciation buildings for $220,000. They would then credit buildings for $800,000 and gain on disposal of plant assets for $43,110. This transaction removes the building and associated depreciation for the building from the books of Scott Paper. To record the entry for the operating lease of the building back from General Electric, Scott Paper would debit right-of-use asset for $310,000 and credit lease liability for the same amount. Now we will assume that at least one of the criteria for a finance lease was met. Scott Paper would not remove the building or depreciation from its books because the transaction would be considered to be a financing transaction and not a sale. The transaction would be recorded with a debit to cash and a credit to notes payable for $623,110. In this learning objective, we will describe the lessor's accounting for a direct financing lease. In the chapter, we discussed two types of leases for lessors: sales-type leases and operating leases. We are now going to discuss a third type of lease called a direct financing lease. This type of lease involves a third party besides the lessee and lessor. The third party guarantees the residual value to the lessor. A direct financing lease is similar to a sales-type lease, except that there is a deferral of the gross profit on the sale that is recognized over the life of the lease because of the guarantee of the residual value by the third party. The lessor is said to retain some control of the asset. Even though the residual value is guaranteed, there is some credit risk involved with the third party. We're going to use an example where Ormond Company enters into a leasing agreement with Amazon.com for the use of one of Ormond's standard motorized warehouse package pickers. The lease commences on January 1st, 2020 for a term of 3 years. It is non-cancelable and requires equal rental payments, but this time the payments are due at the end of each year. So this will be an ordinary annuity. The picker has a fair value of $30,000 and a carrying value of $28,000 on Ormond's books, and an estimated residual value of $6,000 at the end of the lease. The estimated economic life of the picker is 5 years, and Amazon provides a guarantee that the residual value will be at least $6,000 at the end of the lease. There are no renewal options, and the picker reverts to Ormond at the termination of the lease. Ormond sets the annual rental rate to earn a rate of return of 6%, and the payments are determined to be $9,338.64 as shown on this slide. Notice that since the payments are due at the end of the period, the factor of 2.67301 is from the ordinary annuity table for 3 years at 6%. Otherwise, the calculations are the same as those we have already studied in Chapter 21. As this slide shows, we see that the lease would meet the present value test for a sales-type lease because the present value of the lease payments is $30,000, which is equal to the fair market value of the picker. To record the sales-type lease, Ormond would debit lease receivable for $30,000 and cost of goods sold for $28,000 and credit sales revenue for $30,000 and inventory for $28,000. Thus, the entire gross profit on the sale of $2,000 is recognized at the inception of the lease. Now we are going to consider this same lease as if the $6,000 is not guaranteed by Amazon but by an unrelated third party. In this case, the lease would be considered to be a direct financing lease instead of a sales-type lease. In a direct financing lease, Ormond would defer the gross profit on the sale of $2,000 and record the lease by debiting lease receivable for $30,000 and crediting deferred gross profit for $2,000 and inventory for $28,000. This is the amortization table for a normal sales-type lease with the lease payments due at the end of the period. Notice there is no payment due at the inception of the lease. The payments are due each December 31st. The interest expense is calculated by multiplying the 6% rate times the carrying value of the lease liability. The amount, $6,000, is equal to the residual value of the picker. Since Amazon.com guaranteed this amount, they will either need to return the picker and it would be worth the $6,000, or they would have to pay Ormond cash for the difference in the value. Now we are going to see how the amortization schedule changes when there is a direct financing lease. In order to recognize the deferred gross profit of $2,000, the interest rate is going to be changed to 9.5%, the rate that would equate the net receivable of $28,000 with the future amount of $6,000 and payments of $9,338.64. You can check this calculation on your financial calculator by using n equals 3, present value equal $28,000, payment is a negative $9,338.64, and future value is a negative $6,000, and solve for IY. Don't forget to make sure your calculator is set for end of period payments for an ordinary annuity. To record the receipt of the annual lease payments, Ormond would debit cash for $9,338.64, deferred gross profit for $860, which is the difference between the interest at 9.5% on the $28,000 net lease receivable, $2,660, and interest at the regular rate of 6% on the entire $3,000 lease receivable, which is $1,800. And then they would credit lease revenue for $2,660 and lease receivable for $7,538.64. Notice that the lease revenue includes the regular interest of $1,800 and a portion, $860, of the deferred gross profit of $2,000. Similar entries would be made for the second and third payments. Eventually, all of the deferred gross profit would be recognized over the life of the lease. At the end of the lease, Amazon would return the picker to Ormond, and if it was worth the $6,000, Ormond would debit inventory and credit lease receivable for the $6,000. If it was not, the third party would have to pay for the difference in the value of the picker and the $6,000 guaranteed residual value. These are the quiz hints for Chapter 21. Remember, it is always a good idea to do the homework before you attempt the quizzes. These are the only two problems on the exam that involve leases. Be sure you know how to calculate a lease liability for a finance lease and the amount of interest revenue for a sales type lease as illustrated in your text. This is the conclusion of the third presentation for Chapter 21, Accounting for Leases.